So, Heini, I'm going to start off with sort of a broad question just to create some context for us here. And you've been in the business for a couple decades, I understand.
I'm very old.
So why don't you give us a quick, just, look at what you've seen in the world of technology and innovation over the last couple decades and maybe some of the shifts and transitions.
Sure, thank you. So when I started in a business, a conference like this, everybody would be wearing coats and ties. It was a very formal white shoe industry. VCs were ivory tower wizards that made investments in companies like Apple and Microsoft and
Very serious,
Cisco.
right?
Very serious business. And then 2000, the dot-com crash happened. VCs went from about 1,000 or so firms, 1,200 firms in 2000 to about 600, 556 firms in 2003. The money that coming into venture greatly decreased, and it became a scrappy business. You had to know a little bit about technology, you had to know a little bit about finance, and you had to be very creative with your investments. And because consumer investments all failed, Webvan failed in 2000, nobody wanted to do consumer, so the emerging managers, the new guys on the block, started doing investments like in Alibaba and Pandora and Spotify and all these great consumer brands now. Google, Facebook, Instagram, WhatsApp, they all did extremely well in that period between 2000 and 2010. And because of all that wealth, more money poured into the asset class. We went from 600 firms in 2003 to about 3,000 firms in 2010. Endowments, pension plans, foundations increased their assets to venture, and the business mushroomed. VCs now, everybody wanted to be a VC. Nobody wanted to be an investment banker anymore. Everybody wanted to be a VC, so you had a lot of Stanford and Harvard MBA, no offense, come into the business, and I call them spreadsheet investors. If you don't have revenue, if you don't have metrics, if you don't have a financial plan, you're not going to get investment from those growth capital folks or financial capital folks. And they manage the big money. They manage the billion-dollar funds. You've heard the names, whether it's SoftBank, Coatue, Tiger, they're all financial investors. And they were doling out hundreds of millions of dollars. And they were all doing enterprise software because enterprise software was easy to understand. You didn't need to know the technology. All you need to do is look at the ARR, or your magic number.
That linear
Exactly.
hockey stick growth.
And it was a linear growth curve for enterprise software company. You do 5 million, 10 million, 25 million, 50 million, 150 million, et cetera. That was a typical enterprise software story. And valuations for enterprise software went from 3 to 5 times forward revenue to 20 to 50 times forward revenue. Look up snowflakes. And that was huge. And then we've had the financial crisis since COVID. I think enterprise software valuations have gone from 50 times forward now to back to about 5 times forward revenue, which is more reasonable. And frankly, enterprise software is at risk because of what's happening with AI. So all of that stuff means that venture capital market has changed. The funding sources, the types of VCs have changed. So it really depends on who you're sitting across and what you're pitching to have it make sense. So how many people here are raising their seed round? How many are raising Series A, Series B? So of the Series B, what do your financials look like? Are they $10, $20 million of revenue? Because for the Series B, you're going to talk to a growth investor, and they don't understand deep tech. They have no clue what quantum computing is, semiconductors. They don't understand those processes. All they understand is numbers. So by the Series B, if you don't have numbers and you're trying to get growth capital, it's going to be very, very difficult. So for us and many of the early stage deep tech investors, we are super concerned about financing risk. There's 4 risks to venture capital. There's product risk or technology risk. There's management team risk. And then there's market risk. Those are the big 3 that people used to talk about all the time. But I think in times like we are in today, financing risk is probably the most important thing for us.
Well, can we start there then? So let's start with the seed round, because I think I saw the most hands go up for that. So as they're reaching out to pitch, Maybe you could give us some guidance in terms of even how they filter, who they pitch to, what they say in their initial pitches, maybe some really practical advice around how to do that.
So I think, honestly, the seed round is probably the hardest and sometimes the easiest to raise, because you don't need to have anything in your hand for most seed investors. If you're looking for a $1 to $2 million seed check, that should be easy to raise if you have passion, if you understand the problem that you're trying to solve. What is the problem you're trying to solve? Is it a big problem? Is it a $1 billion plus problem? And how hard is it to solve that problem? I met a company yesterday. They're trying to build an airplane, a hybrid airplane. And I asked him, how much money do you need to get a plane off the ground? And he said, $1 billion. I'm like, how are you going to raise $1 billion in the market where capital is constrained? Do you have milestones? Is there a linear milestone plan in place that shows that you can get an airplane off the ground in 5 years or 7 years? And he says, no, we have to build it all at once. There's a lot of science that has to come together all at once. So I'm like, it's going to be impossible for you to raise $1 billion on a story. So
what does he do in that case then?
So I think capital efficient models, so there's two ways to do this, right? You either start off with a capital efficient model. If you can prove and you can get in the tens of millions of revenue for your Series B to rate with $50 million, I think you have a shot. Because I think if you can get to tens of millions of dollars, you can raise a $50 million round pretty easily with growth capital.
And can you explain a little bit some of the milestones that really pique your interest in what you're really looking for?
So we were talking about IonQ in the green room. We invested in a company called IonQ. They did a quantum computer company. It went public successfully. And when we invested in this Series B, they were sitting at about, I think, 16 qubits. And I said, well, what are you going to do with our money? They were raising $30 million. And what are you going to do with my money? He's like, with this money, we can get to 30 qubits and high fidelity qubits. And once we do that, then we can prove these are the problems we can solve and these are the solutions we have. If we could do that, they'll be able to raise a $50 million round, which will get us to 100 qubits. I said, who are the customers along the way? And like, well, I think I can sell Amazon and Microsoft. So I said, why do you think that? Well, I spent a lot of time with the CIOs of both those firms, and they both like what we're doing, and they want to use it for some experimentation. Great, put me in touch with Amazon and Microsoft.
Put you in touch?
Yeah.
And you spoke with potential clients?
I spoke with a potential customer, and they got me excited, and I'm like, okay. This is worth the bet. This is worth the risk.
Okay, so if I can just jump in there, because I speak with a lot of PhDs and scientists who don't want to overpromise and underdeliver. So they tend to really be very conservative in saying what they can do.
Europeans.
Not Americans? Okay, so let's talk about the cultural difference and maybe what Europeans could keep in mind, and how they can stay in integrity but still get investors excited about an idea.
So I like to work in brackets.
Okay.
Right? When I say brackets, like what's the least likely to the most likely, right? And how do you think about that process? We're humans. We're not computers. We don't work with fixed points of data, fixed points of time. If you're trying to build something, it's going to take time, and you don't know exactly how much time, and you don't know what the actual end result's going to look like.
And you don't expect them to as an investor.
The worst thing is you come in and you act all confident. It's like, this is what we're building, and we'll have it on February 17th.
Right.
I will look at the founder, I'm like, there's zero chance of that happening, right?
Yeah.
And I probably won't invest. But if he or she tells me, like, hey, this is the product we're building, this is how we're going to build it. We're going to be talking to this customer, along the way to make sure that we're meeting what they need. And by the end of 2026, we're going to have a product that's going to address the problem that we're trying to solve for them. That's more believable. That's way more believable. And if that's what you want, as a seed pitch, if I don't believe you, I'm not going to invest.
So it's more directional with some key milestones or key targets.
And by the way, I'm talking about early stage VCs that put the investment decision on the seed on the founder. There's some VCs, and I would probably say a lot of VCs in Europe and some VCs in the US, want a lot more concrete data than that. So I'm basically telling you how to pitch me and people like me, which is on a seed investment, it's 100% based on the founder.
The founder's what?
Founder, whether or not they can sell. So, show of hands. What percentage of the job does a founder or CEO have? What percentage of that job is fundraising? Who thinks it's 10%? 20%? 30%? 40%? 50%? 60%? 70%? It's somewhere between, I think it's about 60%. It's obviously more earlier, and then later it gets less, but I think it's about 60%. And as a deep tech founder, you guys are all nerds. You're geeks. You don't know how to sell, and you think salespeople are trash, right? Marketing is bullshit. You just build it, they will come. That is 100% wrong.
And we have a panel tomorrow talking about that.
Have you guys ever heard of a company called Liquid Death?
Yeah.
It's a water can company in the US. They literally put tap water in a can. It's worth $1.5 billion. It's as a deep tech investor, I snub I tip my nose to it. It's just, it doesn't make any sense. But the company built a brand, and that brand is worth $1.5 billion. It's not about the water, it's about the brand. And so as a deep tech founder, I urge you to accept marketing and sales as part of your job as well.
Okay. Can I ask a question also? Because you mentioned spreadsheet investors. What is the opposite or an alternative to a spreadsheet investor? What do you consider yourself, for example?
I think a vast majority of early stage deep tech VCs are recovering nerds, right? We like computer science, we like science fiction, we want to solve big problems. And we want to believe the dream. So if you come to me, it's like, hey, I have this amazing idea of fusion energy. I'm like, great, how are you going to do it? Well, we're going to invent lasers to compress the matter. And I'm using a simplistic analogy here. And those lasers are going to be able to do some amazing things, including compress the matter, and then we'll ignite it and we'll have net positive energy. I want to believe that. The problem is, it's going to take us 10 years to get to a plant, and you're going to need $1 billion. Now, this is actually a true story. The founders came back to me a few weeks later and says, hey, you're absolutely right. It's going to take way too long for us to show any real progress, and there's no way I can raise the money to do that. However, one of our technical founders has discovered that one of the lasers we've invented can see through walls. And so we put the laser in front of a container, a shipping container, and we're able to figure out exactly what's inside the shipping container,
Wow.
including the chemical compounds of what's inside.
Ka-ching, ka-ching.
I'm like, what? When can you show me a prototype? He goes, I need $30 million in 2 years, and I'll show you a prototype. I'm like, great, find a customer.
Ah, okay.
Another week later, he comes back and says, hey, there's a nuclear energy company in Europe that has a problem with their containers. So 2 weeks later, he says there's an energy company in Europe that has a problem with their nuclear containers. They need to inspect them every year, and they spend $100 million every year to inspect the nuclear containers. We can do it for less than a tenth of that price.
Okay.
And they sign I'm going to try to get them to sign an LOI for us to do this in 2 years. Great, I want to invest.
Uh-huh.
That's how you do it.
So was that a true accident that he figured out, or were they actively looking for potential use cases?
They were, I'm exaggerating the story a little bit. They were looking at potential use cases for the lasers, and one of the things they saw, they kind of knew that already.
Uh-huh.
But by us pushing on, like,
Right.
hey, what's the commercialization
frame.
aspect of this? What's the time frame? What do you need to? How much money do you need for a prototype? That's what they came back with.
Okay, a little urgency created creativity.
Yeah, because there's no way that he was going to try to raise $100 million for a nuclear fusion company. Nobody's going to invest in that. I don't have $1 billion. I'm a geek. I understand the science, kind of understand the science, but there's no way that he's going to be able to raise $100 million from me because we're not big enough. I mean, a $300 million fund. Most early stage deep tech VCs manage between $100 to $500 million, which is not a lot. So we can't write a $50 million check.
Okay. Well, why don't we, if anyone has any questions, we'll save a few minutes. Does anybody have a question they'd like to ask?
I heard Europeans are shy and they don't like to ask questions. They would rather text it. Is that true?
This is your chance.
No questions?
Can I just say thank you then, because I think this is amazing stuff, and I'm actually surprised that there are so few founders are here, because these are amazing insights. And
You have a competitive advantage now.
yeah, I'm not a founder. I want these kind of people to bring to my founder. I can tell that, but you need to hear from the one who is or is not investing. So
What are you finding valuable about it?
because it's so clear and also points out the sense of urgency that many founders that I work with that I love are missing because they do not understand the game effect. By the way, the event, but also that this use case and finding that customer, not finding the right customer, finding the customer that may convince an investor, that's so important. And it's really difficult to explain. Very early stage digital founders that come
They need to be more pragmatic, right?
I see a few hand raised up here. Maybe we can bring a microphone.
We can hear you. I'll repeat it.
I think we're recording, so it's nicer if we can hear. Yeah.
There's a lot of capitalists, venture capitalists that ask a product in 2 years, or a little bit more or less that time. Medical device is impossible to reach to market in that time. Even you have a very good idea and even some clinical data, medical device regulations is a timeline of 5 to 7 years. How we solve that?
Okay, so you're talking about a medical device. This is just one person's opinion. I don't represent all of venture capital. Medical devices are really hard, in my opinion, because it takes a long time to develop a product. There is a regulatory process that you might go through. In the US, it's the FDA, and I'm afraid to death of the FDA as a venture capitalist because it's a binary event. And if it's positive, fantastic. If it's negative, we're
Totally
done.
out of your control, too.
And so that's a regulatory event that I don't like as a venture capitalist. We don't do medtech investing because of that. The other thing as well is that for a medical device company, I haven't seen the value at the exit that's worth the risk that we just talked about. Most medical device companies that I've seen get acquired for $300 to $500 million. But to take that kind of risk, given the regulatory risk and the timeline, for me, I would need $1 billion plus outcome. So you must be going after a gigantic market in order for me to get excited about a medtech device.
Thank you.
One more question? We have 1 minute. I think there was one up here.
Thank you. I'm very curious about when you feel like you're about to close and you have like 6 good VCs doing technical DDs and you're like into your 5th meeting. How do you close? How do you get that? I mean, yeah, how do you close?
Okay, so I'm gonna sound a little bit like a shyster, right? If you think about the human behavior and how humans feel compelled to go into something or not to go into something. If you see a restaurant or a bar and there's a line of people outside the restaurant or bar and there's a red rope, do you want to go in? If you see a car or something you want to buy and there's one in the lot and there's 3 people looking at it at the same time, are you more likely to buy it? And so part of me is you have to play the scarcity card. And so it's like, hey, I'm only raising $5 or $10 million. There's one VC that's leaning forward that wants to take the whole round. I like you, Mr. VC, but in order for me to, like, I'd rather work with you and one other investor. I'll pick you 2, and if you guys can split the round and give me a decent valuation, I'll say no to this other VC and take your money.
So leveraging human emotion,
So you have
basically.
to, exactly. It's a little, it's again, salesmanship, right? When you're going out to a bar or club, it's like, how do you date? It's almost like a dating game, right?
Absolutely. Excellent. I think that's our time. Thank you,
Great.
Haney.
Thank you.